Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Tré Bynoe, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Aviso Wealth. For more details or to send in your questions, check out the show notes at trebynoe.ca/podcast. And if you want to learn more about me, start with episodes 1 and 2. So let's get into the
first video episode. We said that in a different one, but we didn't post the video. So this is
Maybe we won't post this one.
Hopefully this one works.
So this is the 28th episode. I mentioned a little bit about what we was talking about, and as I always change stuff around, but I started building, so it's going to be the order of operations.
Okay.
So
Yep.
kind of I wanted a place that honestly I could send to people and say, this is kind of the structure. This is how, in a vacuum, things that you should be trying to achieve or whatever.
Yeah.
And then I started doing it and realized that there is too much nuance to put it into one episode.
I was
Still too
wondering
much-
why your prep was taking so long. This makes sense.
Still too much to put it in even 2 or 3 episodes, but I thought it'd be better than nothing. So I kind of categorized them of song. So this episode is going to be the order of operations for somebody in professional services.
Okay, give some examples.
Engineer, lawyer, doctor,
Okay.
accountant, anything that the goal will likely be to buy into an existing firm. So this applies to anybody that is going to be buying into an existing firm,
Okay.
basically.
Yeah.
So it would apply to people that aren't like that as well, if you're like whatever it is, but they're the typical people that will be buying into existing firms.
Yep.
So this is the order of operations for those people. And then we have other ones. So we'll be doing one on employees, just, the vast majority of people, just regular employees, and then people wanting to start a business.
Mhm.
We'll be doing one on those as well. And then self-employed people that strictly want to be self-employed.
I'm not gonna lie, the whole time, like I thought this episode was going to be like, pay down your debt and then have an emergency savings. Like the order of operations. I don't know.
That's fair, yeah. One thing that isn't on here is those things.
Oh,
So
good.
if you want that, go to Gordon Ramsay. Go to Dave Ramsay.
I didn't even catch it. I was like,
Yeah, it's fine. Go to Gordon Ramsay.
Gordon Ramsay.
Yeah, go to Dave Ramsay. There's so much out there for the basics of just being good stewards in general with your money. So this is not that. This is me prioritizing certain things that would be useful for your life versus just, hey, let's do the basics. So
Yeah.
This is not the basics of that. Maybe I'll do one aside
I
from
feel
that
like
on the
you don't need
basics,
to.
but,
Yeah, probably.
this is not that.
Okay.
Okay, so as I said, people buying into their firms. We're going to go through a fair amount of information. So if I start rambling, tell me and I'll
What do you want me to
cut it
say?
short.
Code word,
Just stop rambling.
redfish. I don't know.
All right. Okay. Yeah. So first one, what do you think's first on this list?
I have no idea. I'm not gonna lie. Like I just told you I thought we were doing something completely different, and then you're like talking about all these categories. I'm like, I have no idea what we're talking about today. So
Okay. First one, master personal consumption. That
okay.
is going to be first on every single one of these
So
lists.
basically, what I mentioned, make sure you're doing that
Yes.
first.
All of that stuff.
Yeah.
If you have not mastered personal consumption, there is no amount of earning. You cannot out earn bad habits,
Yeah.
right? You can postpone them. A really high income can help you hide them for a time being. There's lots of things that high income can do, but you will not. Eventually, they will catch up to you, and you just won't be able to. So the first things first. No messing around. Master personal consumption. I don't care what the number is, but master personal consumption. We've done other episodes on how I recommend people do it, but it doesn't really matter. You just need to be able to say, this is the amount that I am spending within 10, 20% a year, right?
Yeah.
So if your spending is $100,000, if you're like, okay, between 100 and it's sometimes 110 or sometimes 90, you know, that's fine. If you're saying it's 100 and we're planning around 100 and suddenly it's 250, everything we did was useless, completely useless.
Yeah.
So you need a number to be able to plan around. Second thing is to make sure that you cover that personal consumption with insurance.
Okay.
Kind of went through risk management episode a little bit.
Yeah.
Why do you think I would say that?
Cover personal consumption with insurance.
Yes, like the amount that you're spending and
Because maybe because if something goes really wrong in your career, because these people are going to, or not are going to, could get like sued, disbarred. I'm thinking.
yeah, there's lots of things that could happen.
Yeah.
It's the first layer of protection, right? When you
Or
think
like
of
disabled, like
Yeah.
disability insurance.
when you think of your biggest asset, people think of the house, they think of whatever. God?
It's your ability to earn.
Yes.
That's your biggest asset.
Absolutely it is. And at this point, that is most people's biggest asset. That might change, you know,
Yeah.
if you own a business or whatever later on and it functions without you, that, you know, that can change. But the vast majority of people, their biggest asset, especially starting out, is their ability to earn an income. So you need to protect your ability to earn an income.
Makes
Hence,
sense.
term life and disability insurance. Term life is to protect those around you, and disability is to protect you and those around you. Okay.
Makes sense. Yeah.
Then this is where looking in the future starts to happen and maybe is a little bit more difficult for some people, but you need to select your long-term tax bracket. So, for instance, if I'm going to be planning around a $180,000 tax bracket, then that's what my planning is around. And that will depend. It'll be different for each person. It will largely depend on personal consumption. You need to make sure it's high enough that it will cover your personal consumption. But really, you kind of want to, especially for most of these people, you want to be aiming for something so that you know other areas of this puzzle. Okay.
Yeah, that makes sense. Like you have to have some sort of benchmark.
Yeah.
Because I'm thinking about like RRSPs and like the other tax stuff.
Yeah.
Very professional.
Yeah.
Word
a lot
for
of
me.
it is based around tax bracket, right?
Yeah.
So we minimizing taxes long term and not getting blinded by, oh, maybe I can save $3 of tax now. But if me saving $3 of tax now means that I can't save $4.50 of tax.
Oh.
150.
I don't know.
I'm thinking.
I'm like, who cares if you're saving $3? Sorry. I'm like, what?
I meant like 30%, right? Like I'm thinking $10 of income. If I can save 30% of that
Yeah.
now, why would I do that when I can save 45% tomorrow? You know? So pick your long-term tax bracket.
Yeah.
Fourth thing, maximize TFSAs. That's where you want to be prioritizing. That's when you've mastered your personal consumption. Every penny that isn't part of that, that's where it goes. There is no downside to that. That's where it goes. Make sure. And again, another thing that isn't on these lists is how to invest and things like that. I'm assuming all of that is done correctly.
That's in the personal consumption.
Yeah. Before you do this, all of that,
Yeah.
I'm just assuming that's all done correctly. So then when you're maximizing your TFSAs, what do you think comes after that? You've maximized your TFSAs. What then?
Either probably non-registered RSP, like start something to do with taxes.
Yeah, let me go backwards. Sorry, I missed a point. On the third one, where you select your long-term tax bracket, you want to be using RSPs at that point to hit that long-term tax bracket.
Okay. Yep, makes sense because you're deferring the tax till your higher earning years, right?
You're deferring tax in a year now that you're earning higher. So let's say you pick that $180,000. Let's say
Right.
anything over that, you want to be making sure that your taxable income isn't above that $180,000. So
Okay.
that's how you determine how much RSP contributions and things like that you're doing.
Gotcha.
Okay.
Yep.
So then you maximize tax bracket, your TFSAs. Sorry.
And then I said non-registered. I don't know.
Absolutely. Yeah.
I'm
You
going.
start-
This sounds very similar to personal, actually.
Yeah. So you start building a non-registered account. What do you think that non-registered account is now for?
Probably this is for, okay, quick question. Is this for the person? Like you're saying personal consumption and stuff. Is this for a corporation?
No, this is for
This is for the individual?
individual that is in a career path where they'll likely be buying into a firm
Okay, so
or a
that's
company.
probably what you're saving for is like your opportunities in business.
Yeah. So there's two things that you want to hit. You want to hit tax efficiency when it comes to your debt, so
Mhm.
debt efficiency, and you want to be able to buy into a firm. People think that wealth creation is luck. 99.9% of it is not that. It's being in a position to take advantage of opportunity when it comes knocking.
Mhm.
For example, you get the opportunity to buy into a profitable firm. 9 times out of 10, you should be taking that opportunity. You can't, if you haven't put yourself in a situation where you could buy into the firm, you can't then be upset that in 10 years' time, the gap between you and your coworker who did buy into the firm is now millions of dollars
Yeah.
because they're in a position to take advantage of it.
Yep.
So putting yourself, if you're in those type of career paths where that is a likely possibility, that's what you should be preparing yourself for. There is no amount of RSP savings that is going to catapult you past owning part of a firm.
Yeah. For
It's
sure.
it's just not gonna happen.
Yeah.
So prioritize being part of that. There's some caveats with that, of course, like everything, but in
Yeah.
general, that's
This
what
is
you should be
the
prioritizing.
yeah. This is an overview.
Yeah. Okay, so yeah, building a non-registered account for future buy-ins and tax efficiency. And then you want to be achieving tax efficiency in your non-registered account. So it's always how much should I be saving in my non-registered account? So I
Mhm.
think you should either achieve tax efficiency or hit 2 times your annual income,
Okay.
whichever one's higher. That at that point it should be enough to get you through any bumps in like any increases in spending. I'm thinking vehicles, things like that.
Mhm.
But also get you 90% of the way to, I mean, if you've achieved tax efficiency and you have a $500,000 mortgage, well, depending on how you achieve tax efficiency with the debt, you already have, two, three, four, $500,000 sitting in a non-registered account. You probably don't need a whole ton more than that. The growth and the interest should pay for the vehicles that you need and things like that, right? That basics.
Yep.
Okay. After that, you want to be maximizing your personal tax beneficial accounts.
Nice.
RSBs, TFSAs if they aren't already maxed. IPPs, so individual pension plans, is something that we've never talked about on here, I don't think.
No, I don't think
But
so.
an individual pension plan is basically an RSP on steroids specifically for business owners. So people that, well, it's not just for business owners, but that's really where you see it used. It's, a defined benefit plan.
I know. Yeah. A little bit. Yeah.
A little bit. So think of like the teachers have them.
Yep.
Most.
That's exactly what I was thinking because you do the presentations and
Yeah. Okay. So So
Yep.
where they basically guarantee you a certain amount for life, there is a calculation there that they do by an actuary does it, and that tells the plan itself how much they need per person to fund it for life,
Right.
basically.
Yep.
But that calculation basically over the age of 40-ish means that you'll be able to put more into that type of plan and defer income on that versus an RRSP
Oh,
for
wow.
an individual. Before that, there's so much time that number tends to be lower.
Yeah.
So it's not worth it. But over that age, especially as you get closer and closer and closer to retirement, then the number adds up really, really, really quickly. Whereas the max you might be able to put into an RSP might be $35,000. The max you can put into an individual pension plan might be double that, triple that, depending on a whole host of factors. So way more complicated, but it's definitely worth it.
Yeah.
Okay. After you've maximized the personal tax efficiency accounts, pretty much everything else gets left in the corporation, in the corporate model. However, whatever that structure it looks like for you, while adhering to good corporate stewardship of a portfolio.
Yeah, like you would have somebody looking after your like your corporation within your entire life. Does that make sense?
No.
Okay. I'm thinking like if you were taking on a client, you wouldn't be like, oh, your corporation is doing this and like you're doing this because it's all affected, but it is kind of separate.
Kind of. I'll list some of the ones, some of the things.
Maybe I shouldn't be. I'm like, this is what you do, right? I have no idea.
So, for example, some of those things would be clearing the notional accounts, which we'll talk about in a later episode.
Oh,
Removing shareholder loans, things like that. Pretty much, I really tried to think of a scenario where it would make sense to invest money inside of a corporation that you can pull out and invest personally for free. I couldn't think of one. I'm sure somebody out there has something, but I couldn't think of one. So pretty much categorically, I would say your default should be any of that type of stuff. Anything that you can get out very tax efficiently, ideally no tax, you should be taking out and investing it personally.
right. Yeah.
After that, you want to, if you haven't already, know that you've achieved all of your retirement goals. So if you stopped investing, if you stopped saving today or within reason, you would achieve
Your
whatever
retirement.
the goals that the retirement, you have enough assets, you've accumulated enough wealth for your life, to cover your needs. Then after you've achieved that, then you can start looking at the more complicated insurance type solutions.
Right.
Okay.
Yep.
That's the order.
Okay.
And I'm saying a lot of those solutions are very cool, lots of benefits. They require scale to work properly, and you should only really be looking at them once you've achieved everything else that you need.
Like when you say everything else you need, like in regards to your personal retirement
All
kind of
the
thing?
Yeah, you've accumulated the assets that you need to fund your lifestyle, fund the hopes and dreams that you have, and now you're looking to kind of the next generation. Like you hear a
Okay.
lot of the really cool insurance uses with like whole life and stuff like that. They're used in very wealthy families to a very, very good, great purpose. You need scale. And unfortunately, a lot of people they think that just because somebody with $100 million does it, that they should do it with one or two.
No.
No, it's just no. It's yeah, no. But, that's especially now. But yeah, that's the order that I would. That's what I would tell people to kind of go through that order. You'll be on a really, really good track. Don't ignore the basics like no consumer debt and things like that.
Once again, that's step one.
Yeah, that was the first part. I mean, if you're in credit card debt and stuff like that, then again, different. Different. None of this matters because you're paying 20% and they ain't saving you 20% on taxes. So
Yeah.
okay. So the other thing I wanted to talk about for this one was things that you should consider around the actual buy-in, because I talked about overall, but what you should consider before you pick how you're buying these shares in this company. Okay. So first thing that I would want answers to is if you would qualify, if the sale of these shares that you'd be purchasing would qualify for the lifetime capital gains exemption. And your accountant will be able to help you with that. But basically, do you know what that is?
Like, kind of. You are losing me a little bit. I'm not going to lie. It's
Okay.
I'm slowly. This is the
trajectory.
the
I
trajectory.
knew this might
I'm like
happen.
redfish.
I'm not rambling.
I know. That's the problem. I'm like, how do I? How
Okay.
do I do this?
Lifetime capital gains exemption is $1.25 million that the government lets you have for free.
Okay.
Okay. It basically equals about almost $300,000 of tax savings.
Okay.
Okay. That's really all you need to know about it. So there are certain qualifications. You want to find out if the sale of these shares would qualify for this. Because if it does, then it's worth planning around. If it's not possible, For example, the company isn't even a Canadian company.
Yeah.
It's a dead giveaway that it will not happen, or it's a publicly traded company or anything like that. Then you don't have to worry about it. But if it is possible, you want to find out more information about what it would take for you to be able to qualify, because planning around it is worth it. It's $300,000. It could be multiples of that. It could be, I mean, if you use a trust structure and multiply, I mean, you could be talking about $5+ million of tax-free capital gains. So again, benefits, strong benefits. That's the first thing I'd want to find out. Next thing I'd want to know is, once I purchase these shares, what type of income is going to be coming from these shares?
Okay.
So we've spoken a little bit about the 2 tax brackets within a corporation of active income. So the first one is really low.
Yeah.
So I'm going to say $500,000. It's between $500,000 and $600,000. It doesn't really matter, but on amounts below $500,000, pretty much, you get taxed at a very low rate. And then on active income above that, you get taxed on a much higher rate. And that's because they want to encourage people to take risks and have more capital to take risks with business. Right. So if the income that is coming to you, the profit that is coming to you, is only taxed at that small rate, you would handle that. You would lean towards certain structures when you purchase these shares that allow you to not have to take that personally, because it's only being taxed at a low rate. Okay. So if you can invest money that's only taxed at a low rate, you get more. Yeah. Basically. Less tax, overall, better
more
option.
For you, yeah.
Okay. The other thing I wanted to mention was that a lot of people will rush to have a holdco and like a holding company. Don't do that. Basically, there's a section of the Income Tax Act that will allow you to roll shares from a personal person into a corporation at a later date without paying tax on them, without a deemed disposition in that way that you'd have to pay tax. So don't rush to do it just because it's the trendy thing. It should genuinely be of benefit to you, and it's only really beneficial once you can start leaving money inside of the corporation. Okay. If everything that comes into that corporation, all those dividends you are taking out personally to do either to max out your personal account, your personal tax efficient accounts, or to spend or whatever it is, it's not worth it. The vast majority of the time, just not worth it. So keep it simple. And then once you are in a situation where you do have excess funds,
then you can open it if you need.
Then you can go on a different approach, right?
Yeah. Like you can plan for the information you have right now as much as possible, but then you can also change. Then you can also change if you need to.
Exactly. Yeah. Another thing about that you should be looking at about the actual purchase is it could be a really good opportunity for debt efficiency. This could be the point where you achieve it. So, for example, let's say you're in a family of accountants and your parents really want to be nice and give you a gift to help you purchase into a firm or whatever it is. It would be better that, and you have a mortgage still, it'd be better, I'm going to use round numbers. Let's say you need to purchase, it's $100,000 to purchase into the firm, and you have $100,000 left on your mortgage. It would be better that your parents gift you the money, you go pay off your mortgage,
and then
you then take a mortgage.
Structured debt leverage something. What is it called?
And retake a mortgage and go and buy the shares with that money. So then the interest is tax deductible.
Which is called?
Debt efficiency.
What was that episode called? It was like episode 3 or something, like very early.
Tax efficient debt structures.
Yeah.
What I
tax
called
efficient debt structures.
Yeah.
What did I say? Anyways. That's exactly what I was thinking though.
Okay, good. Yeah. So it'd be better that, I'm going to reiterate now, it'd be better that your parents give you the money, you go pay off your mortgage with it, borrow that money again.
Then go into the firm.
Go into the firm versus your parents giving you the money, you give the money to the firm. Okay. That small change makes a big, big difference. I was just playing around with numbers to see how big of a difference. So on a $500,000 mortgage, the total interest that you'd pay over your lifetime would be, on a 25-year amortization, would be $372,000. So to put it into perspective, if the debt was structured correctly, that's $372,000 less of income that the government would tax you on.
Oh.
So it means total savings of...
Oh, yeah. It's down there.
Yeah, it's down there. It was about $170,000, $180,000 less that you'd be sending to the government in the top tax bracket in Saskatchewan.
Okay, that's a lot.
Yeah, adds up over. You invest that over, like it's a big enough deal that you definitely want to be prioritizing it, especially if you've maxed out your RSPs and things like that. It's huge. Less money, more money for you. Anyway, yeah. So before you do it, because oftentimes you can't go fix it after the fact, or it's very costly. Again, there's a whole host of issues. Don't run into those issues. Think about it beforehand. Get help with it.
Yep.
And then the last one, I want to mention this. This all changes if you are paying. Yeah, I know this is the issue. But this all changes if you are paying costs for the business. So I've assumed here that it's a profitable business that pays its own. You don't have to put any money into the business to run the day-to-day, right? You're not funding the business personally. This isn't you building the business. This is the business
is there, and you're going to like take some ownership of it.
Yes. The only thing that's ever really going to happen in that transaction is the business paying you profits. As soon as you're paying into to cover expenses of the business, and that's the expectation, things change.
I like give an example because that sounds weird if you're not part owner.
So going out on your own. I'm a lawyer. I've decided to go start my own firm. I'm going to personally be paying the costs to start this firm.
Right. Because you're like basically, it's a firm, but you're kind of like solo at the moment.
Yeah, it has no revenue. You're building it, right? You're building a business just like any other. You're an accountant and you want to go independent and start your own practice. Like all of that stuff requires capital to start. So if that capital is going to be coming from you personally, ignore all of this and listen to the episode that you can't listen to right now because it'll be in 3 or 4 weeks. But then I'm going to cover what the order of operations if you are building a business. And
right.
Okay.
Yep.
That's it. I tried to keep it as quick and as short as possible because I knew I would lose you.
Oh, yeah. You're absolutely right on that. I was trying hard. I was like, okay, it's like...
Yeah, I know it's late as well. So
yes, it is.
Terrible day with Araya. So
yes, we did. And
anyway,
terrible last few nights. We're running on very little sleep right now.
Yeah,
so
brutal. But on the plus side, we got our sign.
Yeah. Oh, is it not in focus?
Well, let's hope that hasn't been that way for the whole time.
Oh boy.
Well, maybe this will be an audio episode. Well, if it is, then it is. Anyway, the next one, as I mentioned already, will be on the employee. So we'll go through that, order of operations, and that's it. So we'll see you guys in the next one.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bynoe, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.